Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Hi, good everyone. How are you going? Thanks for joining us on the podcast today as we navigate property investment. And it's one of those days. It's a great day. The sun is shining. That's always a good thing. And the birds are tweeting. And irrespective of the challenges that Australia faces right now with COVID-19, in particular to our friends and colleagues down in Melbourne and even now in New Zealand who are back into lockdown in Auckland, there are people doing it tough, but that doesn't mean we should sit around as doomsday merchants and talk about all that is wrong. We'd like to talk about all the things that are right. And today is one of those things because it is a Q&A day on the Smart Property Investment Show. And joining me in the studio is Paul Glossop. He is the CEO of Pure Property Investment. How are you, Paul? Are you well?
Very well, Phil. Thanks for having me again, mate.
And it's just not us in the studio today. You're here as well. We're beaming over the marvels of the interweb and across the Smart Property Investment social media channels, the Pure Property social media channels. And for those people that don't know, what are they?
Pure Property on Instagram, Facebook. We're also pretty prevalent on LinkedIn. And yeah, mate, they're all over the place on IGTV and everything else that goes with it.
It's crazy how the world's changed right now. And I'm just thinking now as we're chatting over this, and hi to everyone at home or wherever you are, whether you're on a train or not on a plane, obviously, watching this right now. But I was watching the television last night, Paul, and I saw that Channel 10 has canned like 20 or 30 of its top talent because of budget cuts as a relation to COVID-19. And it just got me thinking how accessible now it is to do broadcasting.
Correct.
Essentially we're broadcasting. We're audio broadcasting. Smart Property Investment Show is one of the top podcasts in the country across social channels. And the Daily Bailey is gone.
Daily Bailey's gone.
Daily Bailey's gone. And
that's it.
Everything's changed. Things have changed. People now stream. If you want content, you go, okay, I've got an hour, I'm going to watch X show, or I've got an hour, I'm going to listen to the Smart Property Investment Show.
Absolutely.
I'm going to flick through my social media and watch guys like us doing this sort of thing.
I completely agree. And the Daily Bailey, the drips and drops across your rooftops and crops. Mate, if I want my weather these days, I go to my app, which I know is probably, unfortunately for the Daily Bailey, a little bit more accurate than your standard generic weather that's going across the city. I want to know what the wind's doing at a certain point in time if I'm going to go for a surf. I want to know what the chance of rain is on that night or that day. The app will tell me in a couple of seconds, and I go there when I need it, and I go there ad-free. And I guess that is the way of the world.
Well, it's not ad-free on the Smart Property Investment Show. We have some great supporters, and thank you to all. And I think you're one of them as well.
I definitely am.
And a big shout out to all those people who are supporters of the Smart Property Investment Show. It's a really good way for us to also highlight some of the great service providers and products that are in the market. So keep tuning in. But I heard on the grapevine, Paul, and this is sort of connected because it got me thinking about the Daily Bailey. The guy that used to run the traffic helicopter doing the traffic, I hear that he's in property these days. Is this right?
Ironically, he's been in property for probably longer than Vic LaRusso. I actually bought a property for a client last weekend on the northern beaches of Sydney, and Vic LaRusso was the auctioneer. And I actually spoke to Vic. I think you were actually next to me at the time. I was just getting some documents in order the week before to make sure I could bid on behalf of our client. But ironically, Vic LaRusso, who was part of or still is, runs the traffic helicopter.
Does he still run the traffic helicopter?
Absolutely. He's moonlighting as an auctioneer, but I think he's had his auctioneering business for over almost 20 years.
Is he a good auctioneer?
He's actually very good. I think he specialises only in the northern beaches. Ironically, the house that we bought for our client, he actually grew up on the same street. So I think he's northern beaches local, born and bred. Yeah, he knew it pretty well. But he's a good operator. He was really good on the phone. He's educational, insightful, very accessible, and I think very good at what he does for a living, hence why he's had a very long career.
Well, he's kept Australia informed about traffic accidents for many, many years.
And property, evidently.
And property. That's one of those things, though, like going back to the Daily Bailey, you can get your weather on your phone, but it's pretty hard when you're driving in your car to get the weather on your phone because you're not allowed to use it, right? Correct. So you still need to go through the audio channels.
Yeah.
Maybe we've got to feed in somehow live weather reports in the Smart Property Investment Show.
Well, there you go, but it's got to be geo-tagged.
This is the future.
Geo-tagged.
This is the future.
A quick update on your suburb that you're looking at and the local property price growth over the last month, 12 months, vacancy rates. Imagine that. You could just hit it.
So you're driving on going, Phil, you're currently driving through Blacktown. The current price is...
And average annual growth in Blacktown, 6.1%. Vacancy rate currently in freestanding houses, 2.4%.
Visionaries. We're visionaries. You know what? I don't know, this sort of technology is going to be available in a couple of years, but in 10 years' time, it'll definitely be there.
You can data scrape it now. If you really wanted to, that's possible to grab all that data now. And there's some companies out there do it, but audio-wise, it could be there.
We're just giving someone a bazillion-dollar idea, but we do digress. Now, Paul, we've had heaps of questions in lately through smartpropertyinvestment.com.au, and send your questions, editor at smartpropertyinvestment.com.au. You can also send your audio questions through wherever you're listening to this right now, whichever page on the Smart Property Investment Show. There's a little button that says click here, and you can record your question, and we get them answered. We'll find someone to come into the studio who knows what they're talking about, i.e. not me, to help navigate these things. Now, Paul, we've been getting so many COVID questions around over the last few weeks, as you would expect. So what I've done, I've glued a couple together and taken some bits out, which I thought would be most relevant to our listeners right across the nation and also globally. We've got a big global audience now as well. There's a lot of, it's a lot less now because they've all come back to Australia, but sort of expats up in Asia or Europe, in particular the UK and also the US, who are investing in property. I don't know if you've got any clients that do that.
Plenty. We've got plenty. We've got clients based in Middle East, Asia, North America,
Aussie expats,
Europe, Aussie expats.
Trying to get their money back to Oz.
And even some who have got family here and going through legal channels and figuring out ways to buy property, whether they're going to live in it, whether it's going to be a straight up long-term investment. Plenty of clients. Probably about 15% of our clients are based somewhere overseas.
Really? Sorry, just on that. So they're getting Aussie mortgages, or are they paying with cash money?
It depends on which country. It really does. But you will get a small portion to be cash, but predominantly they're still leveraged. So, and that is part of our ability, is we need to interlink them with brokers potentially based in Australia who will work with them, who are a specialist in expat. And that is a very specialist market, because there is certain accreditations, certain banks who are much more obviously well positioned and want to grab onto that overseas money as well. But the Citibanks of the world, those types of global organizations, that's typically where the clients
How do they go? Say if you're in, you said the Middle East, I imagine Dubai. How are they getting money back from Dubai to pay for deposits on properties in Australia? I imagine there's a fair bit of sort of FX type stuff going on.
Yeah, there is a fair bit. A lot of the time they'll also still have an Australian bank account that's active. So they'll have that money already sitting here, or they'll transfer it here for deposits there. So essentially it's all very visible and it's got continuity. Okay.
All right. Nice one. So we'll go to a break. Let's do a first question. This is from Melissa J in Adelaide. Thanks, Melissa, for writing in. It was quite a long question she had, Paul, but what I've crystallized it into is which markets are currently growing in COVID. So everyone's talking about negative markets, property prices going back, 5% drop. Commonwealth Bank came out really early on in the pandemic saying at worst there's going to be a 30% drop in property prices. And I think everyone's sort of, after a couple of months, gone, yeah, it's not going to be that bad. Sort of most people are now aiming at that sort of 5 to 10% mark. Who knows what's going to happen with this current outbreak in Victoria? It's going to be a real backwards step in the economy down there. Are markets growing in COVID?
Yeah, absolutely, in short. And I think to that point of the generalisation of where markets are actually going, the unfortunate part is data will always be skewed. If you look at the average data across Australia, it's always going to be skewed by what's happening in Sydney and Melbourne, because the majority of the volume and the transactions happen there. So if that market goes up, the market looks great. Down, market looks terrible. If you take into account the CoreLogic data that was released as of a couple of weeks ago, based on the quarters of the last quarter of last financial year, so essentially quarter 2 of this calendar year, and that is effectively really the bulk of where COVID has had its impact, and that's from essentially April to June. The markets, if you look at Sydney, minus 2.2%, Melbourne minus 3.2%. But if you go to outside of those two major markets, and to be honest with you, Melbourne probably saw the worst month of July, back end of July, where you obviously saw stage 4 restrictions were imposed, and we've now got different things that happen there. I do expect there'll be a couple more subsequent months that'll be worse off there. Sydney's actually relatively balanced. If you take out the high density apartment market and some of the very high end $6, $7, $8 million, $10 million plus markets, which see a lot of fluctuation at any times anyway. The rest of the markets, to be honest with you, are very balanced, especially freestanding houses or boutique apartment markets. You go up to Brisbane, you're around about neutral. Some markets have seen a little bit of growth. Some markets have seen up to maybe 1% reduction. But again, depending on the property type, you're basically at the same point you were in March. Go over to Canberra, you've actually seen close to 1.5% growth in the last 4 months. Down to Adelaide, you've seen close to 1% growth. Hobart's about flat. It's seen some months of growth, some months of retraction. Perth is actually about flat as well. Darwin is still off a bit, and Darwin had problems well before COVID and was still going through its basing out. But it's a market that's probably seen far less retraction than a lot of people would have expected that to do as well.
So if you haven't seen it, go and check it out. Smart Property Investment Show about a week or so ago, I had a really good discussion with Cameron Kusher, who you would know or know of, is with REA Group these
now,
days as one of its sort of senior property analysts. And we went through a state of the market right across the nation looking at capital growth values and also vacancy rates. So two metrics which determine, the performance of a property or why you're investing in property. So go and check that out. It's a really good piece. It's quite a long one, but all the information that Paul just mentioned there, we sort of deep dive into that as well. My view on this, Melissa, it's the right question to be asking what markets are currently growing in COVID, but you need to be thinking about what's happening after COVID as well and whether or not there's a relationship between the two. And I would say there would be, but you need to determine what they are. But don't get obsessed with growth right now. Don't start at the growth side as in, I want to invest in property, I want to find a growth market. You got to start right back at the beginning. And now more than ever before, there's no shortcuts in property investment, is there?
Absolutely. And it doesn't change the fundamentals of what should have been the case 4, 5, 6 months ago. I haven't even mentioned regional markets. And there are definitely regional markets that are showing really good signs and have already shown really good signs during the start. And right now, it's probably 4 or 5 months into COVID. And I completely agree with you, Phil, is that property's always been a slow moving vehicle, regardless of whether you're looking at during a pandemic or during a boom market. The reality is that even during boom markets, something that's 10% plus growth on an annual basis isn't exceptionally, it's quite rare. But even if you look at pure growth basis, if you're playing the equities market versus property, 10% in a year pales in significance with certain markets. But what it doesn't do is doesn't drop 10% the next 2 weeks either. It essentially holds its own. So really the focus that anyone should be looking at is where can I buy really well, that's well positioned now, well positioned for the cash flow I need, fits my budget, but looking at a 3, 5, 8, 10, 15-year cycle, where is that property going to be? Where's that market going to be? And how can I position myself now to buy correctly and buy at a time where there's far less competition and gives me the best opportunity to negotiate a good price on a property that I know I'm going to hold for 15 years?
Okay, that's good counsel. We're going to go a quick break. Back in a moment.
Whether you're an avid property investor or about to buy your first property, why do it alone when you could partner with Australia's best buyer's agent? Director of Pure Property Investment, Property Investment Professionals of Australia board member and REB Buyer's Agent of the Year, Paul Glossop, can take your portfolio to the next level. Get in touch today to discuss your investment goals. Get one-on-one insight from Paul Glossop. And for the first 100 people, this service is completely free. Head to purepropertyinvestment.com today to schedule your consult with Paul Glossop directly.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Paul Glossop from Pure Property Investment. Also, the best-selling author of A Surface Guide to Property Investment.
Surface Guide to Property Investment.
How's that going?
Mate, it's become a bit of a nuisance in its own way because
a nuisance.
We distribute books and essentially we do.
Can't like.
Well, no, it's actually people are buying books left, right, and centre. Like we've sold probably close to 5,000 books now, but I have to keep ordering in books, and we've got all kinds of logistics to actually get them printed, then get them shipped, and then we've got logistics.
So you're on your second run, are you?
We're on our fourth run.
Are you?
Fourth run of property.
Why don't you just do more at the start and get a better price?
But because I don't want to hire a warehouse to put boxes of books in to go down that whole pathway, mate. For me, it was just sharing a story, which I didn't realise would probably go through that level of outlay. And
is this still a first edition, or have you actually changed the edition?
I haven't changed it yet. We're probably only 18 months in. The book's very relevant because I do talk a lot about things like the GFC and the other downturns in this. There's actually
you're going to have to do a COVID
parts.
Update, right?
We definitely will, because I think I'd like to probably hold maybe 18 to 24 months after it, because I think the new world will be the new world. Remote working and all the other things where people want to live in lifestyle areas and they can actually justify it. That's not going to be defined too much yet.
So there's another book. It's not an extension of that book.
I think so. I think that's what I'm already talking
about. COVID life.
No, we're talking about a Surface Guide to Living Your Best Life. And essentially it's going to incorporate a lot more about probably fundamentals of creating wealth, but what does wealth mean to you and how can you actually incorporate property, money, lifestyle and everything that you need to figure that out.
Sounds like a very good concept.
Yeah.
Very good. So now let's go, and I didn't mean for that to be a plug for Paul's book. If anything, I'd like to do an anti-plug.
People can grab it on the website, though.
Personally, I don't understand why anyone is reading this thing. But how do you get it, by the way?
Jump on our website, purepropertyinvestment.com.
And you'll post it out.
And literally there's a free plus shipping. So viewers can grab a free copy to just cover the shipping.
But it's in bookstores as well.
It's in bookstores as well. So you can literally get it online, Amazon, Booktopia, all those places. You can jump on there right now. You'd pay $24.95 for it. Well worth the read, and if anything, it's a decent book stop because it's relatively thick.
So you jam it into a door.
Jam it into a door. Cold winter's nights, you can plug up any gaps.
Get rid of the breeze coming through.
Yeah, absolutely.
All right, there you go. All right, question from Kishan from Melbourne. I hope you're okay in lockdown down there, Kishan, but I do appreciate you writing into us. Again, Kishan had a couple of points, but the one which I thought was a really good discussion for us, Paul, which markets currently have the lowest vacancy rates and rental growth? So this is counter-cyclical to what a lot of people are talking about with COVID. So we don't need to go over too much old ground, but COVID hits, all the students go home, all the Airbnbs become rental properties rather than lifestyle type assets, which are sort of sporadic rentals. All the young professionals go home to mum and dad, or the hospitality workers, because they can't afford rent. So there's a huge exodus of people out of rental properties, and then every investor sitting there going, I've got to discount my rents, coupled with the fact that the government says you can't evict anyone because they're not paying their rent, right? So everyone panics and goes, rents are going through the floor, huge vacancy rates, et cetera, et cetera. So that's the story. That's the narrative that people are hearing, and that's what they're seeing in the media. Now, is there any rental markets, number one, bucking the trend and not having issues, vacancy rate increase? And secondly, can you actually lift your rents up in any markets in COVID?
And this is probably, I field about 20 meetings a week with new clients via Pure Property Investment for people wanting to understand what we do, how we do it, how we might better work with them, etc. Probably I'd say every second meeting I have with a client, this is a question that I get is, what's happening in the rental market? I'm scared to enter now because my property might be vacant for 4 months and I might have to drop my rent. So I really don't want to enter into this market regardless of whether growth's coming or not. Here's the headline for you, is that vacancy rates across Australia as of July 2020 were exactly the same as vacancy rates in Australia as of July 2019. So if you look at every single residential property, 2.1%. As a nation, 2.1% vacancy rates were in 2019 July. July 2020, vacancy rates 2.1%. That is the headline number. However, there are definitely markets which have blown right out. But what did happen, to your point, is that probably around March, April, there was definitely a spike in vacancy. But that spike was exactly as you articulated, Phil, it's in the markets which were dominated by international students, Airbnb, holiday destinations, and lifestyle markets. Ironically, they were some of the blue chip markets. Bondi in Sydney is a classic example of a market that blew out to high vacancy rates, high density apartment blocks in major CBD of Sydney, major CBD of Melbourne. Both of those markets were smashed and still are in pretty bad positions. And the commercial markets in both those same areas, commercial high density in Sydney, high density in Melbourne, they had about a 3% vacancy rate in about 6 months ago. They're predicted now to potentially push out to a 10% vacancy rate in the next 6 to 9 months. They're the markets which have suffered and will continue to most likely suffer for the next 8 to 10 months. That's probably one side of the market which I wouldn't have necessarily suggested should be touched regardless, but that is the market that's hurting. The markets that are actually doing well, Brisbane, freestanding housing markets, essentially vacancy rates haven't shifted. And in some cases, and I can talk about my own personal portfolio, I've got a property in North Brisbane, freestanding house that I can think of that I've actually constructed a granny flat. That granny flat's been tenanted, and I've also raised the rent on the house itself by $10 a week in the last 2.5 months. Now, the rent was probably a little bit under market, but it didn't stop the fact that there was enough demand there for me to say rent's going up. I haven't raised it in about 3 years. Markets such as Canberra, markets such as Adelaide, and definitely Perth, freestanding housing markets in each of those areas have held strong. Perth right now is a touch under 5% value of rent, 5% growth in the last 12 months. It's grown essentially the value, and that's predominantly been the last 6 to 8 months. So there is absolutely, and I can attest to properties we're buying in Perth, freestanding houses right now, where you've got multiple applications prior to settlement on properties we bought which are vacant possession, and you've got your pick of tenants. Hobart as another market, absolutely fever pitch as far as rental demand, and that hasn't really been a thing that's changed in there for the last 4 to 5 years. But COVID, as much as people thought, well, holiday destination tourism market, that's going to be smashed. Hobart's actually held up really well, Launceston and some of those other markets there, because essentially they still haven't built. A lot more people are realising now that things like JobKeeper, JobSeeker, they're supporting those rental markets in those sub $500 a week markets a lot more than that 800 plus, because if someone has had their job affected, those markets actually haven't had the household income affected anywhere near as much. And in some cases, people actually saw a slight pay rise. So if you look at it, that JobKeeper is $750 a week. If you've got 2 people on that, it's $1,500 a week. If your rent's $400 a week, it's less than 25% of your total household income is attributed to rent.
Yeah, so this is the irony of JobKeeper. Some people are doing better off on
some people
JobKeeper,
are, but
right?
even JobSeeker, and the irony is that people in there were still earning $550 a week. Two of those incomes, $1,100 a week. If you had no job and no prospects of a job and didn't want to search for a job,
money.
You still got 30% of your income is coming to your rental, which if you look at how actually rental property managers would look at how someone would qualify and actually looking at a quality tenant or a quality application, they want to see around about maximum 40% of household income has to go to the rent. So these people are all still well and truly able to cover it. And they're the markets which have actually done best. The higher end markets are doing worse.
Obviously, the Smart Property Investment Show is all about me. It's my chance to be more educated about property. So it's the advantage that I have, and it's a real privilege, and that's the case. My portfolio, and I was just thinking about Vacancy Rates, and we've done pretty well through, and we share the Smart Property Investment portfolio. You know, you listen to the show. We've done pretty well. There's been a couple of transitions. I've had to fill a couple of things, and I had a bit of a gap for a little while in one of our properties out in Mount Druitt, 2-bedroom apartment, which is now rented, but I had to drop the rent by like $40 a week, which hurt. But tell me about
that recent, Phil?
Semi-recently, yes.
Yeah, I had the same thing. I got a property in that same market.
About 6 weeks ago.
I reckon I had a property on my own property on the market exactly the same time, and I had to go through the same thing. And that goes to Sydney market. I had a 2-bedroom villa, which I had to drop $35
this is
a
on
week.
Carlisle Street in Mount Druitt.
Yeah, I'm a couple of streets over in Methven Street.
Okay.
Yeah.
I think I know that property.
Yeah, you probably visited it. Help me knock out some walls.
So the western suburbs of Sydney, or we can talk about Logan as well. What you said there, a lot of those jobs or people living in the western suburbs of Sydney, a lot of those jobs have been largely more stable than maybe a lot of the jobs that have been in the suburbs of, let's say, Sydney, for example. So you look at Newtown, Petersham, Enmore, that sort of belt, a lot of hospitality workers, a lot of students, Alexandria, Green Square, a lot of students, a lot of hospitality workers, huge vacancy rates, right? But go out, and this is the relationship between workplace dynamics, livability, how families do all this stuff. You go out the western suburbs of Sydney, a more owner-occupier belt, inverted commas, but a lot of renters out there, but a lot of the renters are in markets which have probably been less disrupted than other markets. Healthcare, nursing, a lot of these type of jobs, huge demand for them at the moment. So what's going on out there? Has it been reasonably stable in vacancy rates?
Reasonably stable. I still think that it's part of the Sydney market, and Sydney market, it is that standard rising tide lifts all ships, and quite the opposite when you've got no interstate migration. And Melbourne and Sydney, whether we like it or not, are highly dependent on migration, and that is what's going to affect this market. And if it affects the high end of town, it's still going to have the ripple effect that if someone says they can get a bit of better value, 2 suburbs close to where they want to be, they'll end up moving there. So that ends up creating vacancy a bit further out as well. So the vacancy in Sydney and the vacancy in Melbourne is going to put pressure on rents unequivocally, and already has, if you take yourself out of those markets. And the reason being, it goes back to ultimately migration. We have no one migrating to this country. Once we get skilled workers back, once we get students back, once we get the hospitality and tourism back, that will come back immediately to both those markets before anywhere else. But they are certainly the markets which I think have been affected, and the data suggests that, but they're the markets which will probably see the long-term lag. But the reality is because we've got lockdowns elsewhere, other markets are essentially going to perform the same way they are right now. That won't change. So if they're performing fine, they will continue to perform fine because we're not seeing supply. And this is the big key here, is that we're not going to see a whole bunch of new properties go up tomorrow. That's all of a sudden going to create this excess supply that we expected. And that's probably one of the big things that we talk about. What happens after COVID is going to be a really, really big shortage of supply.
We're talking about there is construction. So we'll get on to that. Let's go to a break beforehand. We'll be back in a moment.
Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Pure Property Investments, Paul Glossop. That last question around low vacancy rates and growth, you said that year-on-year change is largely plus or minus 0.something%, right?
Aggregating Australia.
Aggregating Australia. And this is the challenge that you have when you're investing in property. A lot of people talk about the Australian property market. There's like thousands of markets within every street, every cluster of houses is its own market. So, it's quite foolish or it's folly to actually talk about the Australian property market. However, it gives you some sort of aggregate view of housing or the dynamics of housing. So you said very little change.
Very little.
Fast forward a year, and we're not property demographers or economists, so it's talking generally. What sort of changes are there going to be, do you reckon?
The way that the data is shaping up now, I think we're going to see a few things which will become much more mainstay. One of which is, well, at least for the next 2 to 4 years, I think we're going to see very much a low volume of new property come to the market. And that's not just Sydney and Melbourne, that's right across the country. And that's going to affect demand exponentially. And I think that's what's going to change things in a very relatively short period of time. That combined with when the government has the ability to start trying to encourage international students, skilled migrants. I think the tourism side of things is what's going to be a longer tail to that one. But I think the two things that the government's already realising is that international students and skilled workers, they're the ones who pay their taxes. They're the ones who contribute to this country a lot more so. And they're the ones who are going to allow us to continue to prosper. And that's what's built this country in the last 50 years, irrespective. So they're the focus points, which I believe the federal government's going to look at, is how do we create these opportunities and these hubs to bring these people back to Australia en masse. And they know that they bring money. And they know that that is what's going to allow us to continue to prosper. For me, that's the key, in addition to low amounts of supply, which will reverse a lot of these issues with regards to vacancy in the major markets. But I do see that the legacy of 2 to 3% interest rates isn't changing. We've got 3 years of that, I believe, somewhere in that range. So very, very cheap money, very low amount of supply. If we're fast forwarding a year, 2 years, for me, the time to acquire those assets now, while everyone else is sitting back thinking, I might just wait 12, 24 months, the time to actually acquire is when you've got the opportunity to see that others are fearful and you're jumping in to grab those opportunities with zero to minimal competition.
Yeah, interest rates are low and there is a lot of fear in the market.
Yep.
And, you know, everyone has their own relationship with risk, and you need to work that out, because that will shape the way in your strategy for investment. And I would recommend you actually speak to some people about making those informed decisions, a buyer's agent, if that's what you like to use, your accountant, your mortgage broker, all this sort of stuff. But we spoke about vacancy rates and strategy now, and let's look at the environment and what it's going to look like for the next period of time before we go to this next question, because it's interconnected, Paul. Right now, we're in New South Wales, recording in Sydney. We can't go to Victoria or Melbourne for business or pleasure. The border is shut with Queensland. Our friends over in Western Australia want their own country.
Sovereign country.
They actually want to saw off that bit of Australia and call it the sovereign state of Western Australia. So we're in New South Wales for this little time, and we're not going on holidays anywhere overseas.
No.
You know, I've not been on a plane, and it's probably the first time in God knows how long, for 6 months. The last time I was on a plane was in February, coming back to Singapore. Haven't been on a plane. So we're in New South Wales right now. Now, speaking of aeroplanes, Byron Bay is one of the busiest airports in Australia at the moment. There is increased flights coming out of Canberra. There's new carriers. Pelican Air, for example, is flying directly from Canberra to Byron Bay. It's crazy up there.
Yep.
You cannot get yourself a holiday house.
No.
Should people, and being a Q&A day, I'm asking a question, it's my privilege, should people be changing their investment strategy to now be buying Airbnb investments in Byron Bay, because you're talking about low vacancy rates and rental growth?
Yeah.
Thoughts?
You've probably opened a big can of worms there, in the sense that I think this comes down to when people, and I liken this back to our mining boom of 08, 09, probably even prior to
Good
that,
analogy.
2005 to 2014, where you literally saw everyone come out of the woodworks, because it was only 3 months ago that Airbnb was a flawed strategy, because all holiday properties were abolished. So essentially they were shut down. So there was everyone who held these properties. They couldn't rent them out legally at all. Fast forward 2 months, and if you're in a certain state and that state has to and wants to holiday, they say, well, where's the most desirable place? And every single state will have that desirable place as well, even if their borders are completely shut. Then all of a sudden you've got high demand. Byron Bay, classic example. Noosa in Queensland going through the roof. You got places up like Ningaloo and those areas in WA, where all of a sudden that regional market, beautiful.
Mornington Peninsula down south, yeah.
These markets are actually seeing a high, I mean, Victoria's probably a different story for the short term, but these markets have seen a heightened amount of demand because people still want to get away and do something. You've got to think, where does this market sit when we do return to normal? And as much as it doesn't feel like it's even fathomable at this point in time, we will return to a state of normality where the airports are open, international migration starts up again, we can travel wherever we want. And it might not be in 6 months, it might not be in 12 months, it might not be in 24 months, but property has never been a 12-month or 24-month investment. And if you go back to the mining boom, the amount of people who sit back now in the late 2020s and say, I would never, ever do that again. And I'd love to see someone who came in with a comment via your bit. And I know you've had different guests on your show who have bought in mining towns and they've ridden the euphoria and then felt the pain.
If you buy the right time and sell at the right time, you're a genius.
Correct.
I don't know a lot of geniuses.
No, I don't either. and I think ultimately it comes down to luck and ability and fulfillment. But the problem is with greed is that you look at it saying short term, it fulfills me. It gives me that little bit of adrenaline hit that I really want. And it makes me feel like I'm a very clever person. And it's quite romantic when you fantasize that I've got a place hypothetically in Byron Bay, whether it's a one bedder or a studio or a sprawling beachfront mansion. It doesn't change the fact that long-term data suggests they're still not going to be the ones that are going to perform the same way. So if you're thinking this way,
if you're sitting there going, I love Byron and I like going over the family, wouldn't it be nice? And I love the cafes and it's a good surf break there with 1,000 people on it.
Yep.
If you get a wave, you're lucky. But when it's good, it's good.
It is good.
What do you do? How do you put the brakes on? Do you put the brakes on? Do you just don't worry about it? Don't do it. Or maybe is the way to look at it, where is the most effective place to stick your money right now to get the best outcomes as a property investor? Now, I don't know many people who invest in property to lose money.
Yeah. And I don't know, I taper it with this, and I know a lot of property investors, as do you. And I look under the bonnet on a lot of property investors. And the beauty about my position is you look under the bonnet of a successful property investor. I can't think of one successful property investor who has a complete portfolio of holiday letting assets. If they do buy that property, it's typically towards the back end of their portfolio when they're saying, you know what, this is for me.
Bit of a lifestyle.
This isn't for money. And if you're successful guests, you've had friends, family, you know it. You know that there's a couple, but the ones who are really successful know that it's delayed gratification. I'm waiting.
Well, and I know you know him as well as I do, and I know he won't have a problem in mentioning this. Steve Waters from the Right Property Group, he reckons the worst property he ever bought was the thing up in Nelson Bay.
Absolutely.
I think he's used it a handful of times, and he went up there during COVID. He just went, it was absolute madness.
Yeah, this is it, right? And you go back to him. I know a good friend of ours, Manzrul Khan, is another person, and he probably hasn't bought necessarily knowing that he's got a couple of well-positioned, not necessarily lifestyle markets, but really desirable markets. But he's bought them. He's bought loads of property over his career, but he's bought those properties which were more for him later down the track. And I know other clients who have done exactly the same things, but I'm not looking at the ones who have done it the reverse order. And that is the challenge. Is I do see a lot of people who've done it, that holiday letting or that studio service department, they've bought it really much at the front, or their desirable Airbnb property, they've bought it within their second investment. That typically is where you roadblock your ability to do anything else.
Okay, so if you're thinking this way, we're not saying don't do it. And by the way, we're not giving any sort of a final advice here. This is just general in nature. Disclaimer, which a couple of guys haven't chat about property. Get someone else to have a look over your shoulder. And if someone's trying to sell you, inverted commas, sell you one of these great assets right now with huge yields and growth potential, just get someone that knows a little about property just to have a look over it at a start. Be really considered about this. But as I said beforehand, this is a philosophy you need to understand if you want to be a successful property investor.
Success leaves clues so much so in this format. And you can see it more, obviously.
Oh, yeah. And a smart property investor is that you need to work out at any given time where your money is going to be most effective. That is what this is all about. It's about the utility of cash to secure something matched with leverage.
Exactly.
If anyone tells you that property investment is any harder than that, run a million miles. That's what it's all about. So it's about investing in the right place at the right time for the right reason. Now people go, well, that's all really quite vague, Phil. Yeah, because everyone's different, right?
Yeah.
But there's a question here from Angelo from Abbotsford. Which markets are best poised for growth post-COVID? So here's the question. Do you wait on the sidelines until COVID goes away and then you start investing, or do you counter-cyclically invest, which some people is a great investment philosophy, to invest while there is challenges and headwinds and all this sort of stuff, so you're the first and Johnny on the spot to merge out of some distress? Thoughts? For Angelo?
Going to the previous comments and questions around buying lifestyle markets, it comes down for me is that a lot of the experts you would have no doubt had on this show would have said over the decades that it's nigh on impossible to predict the bottom of a market as well as the top of a market. And ultimately, the middle of the market's the same thing. If you're waiting, you're typically one of those people who will probably consider that, well, depending if there's a federal election coming up, if there's a state election coming up, if there's potentially a murmur to the changes in stamp duty, there will always be something that will make you think, I'll wait till the outcome of that comes and then I'll figure out what happens in the market. And I can guarantee you that if you take COVID aside, I've got clients who were considering buying around 2017, 2018. Then they thought, oh, hang on, Labor's looking like a shoe-in to get in. They're talking about abolition of negative gearing and a whole bunch of changes to that. I'm going to wait. They'll wait on the sideline, which in certain markets was fine to do. But then you look at the outcome of the federal election and what happened after that. Straight away, we saw Liberal was re-elected back into power. Negative gearing was taken off the table. The market actually bottomed out in around about, depending on which market you looked at, April to July 2019. Between July, August 2019 and March 2020, Sydney and Melbourne, as examples, actually grew by between 12 and 14% in a very short period of time. They're actually on a huge trajectory for growth. The reason why I point that out, and I can go and take snippets out between then and 1917, there's different times where you look at different points in the market. Ultimately, when it comes down to it, if you're buying a property for a 2-year cycle, don't buy property. Because if you really are nervous about what you're buying and why you're buying it right now, and you're thinking what happens in the next 6 months, what happens in the next 12 months, and if I can't afford to have this go wrong, property's not your vehicle. Because ultimately, it truly shouldn't be thought of that way. What you should be looking at is this a well-priced property for what it is and what's moving this property over the long term based on historical growth data, based on where it's located, based on jobs, etc. Does the cash flow and the vacancy rate fit what I can afford to hold based on my buffers and based on my incomes? Have I got everything in place there? If those answers are yes, buy the property and look at it in 5 years' time. Look at it in 10 years' time. Do not expect the next 6, 12, 18 months are going to change. And if they do, fantastic. If they do for the better, even better. If they do for the worse, fine. You're in a position where your cash flow, as long as you've looked at those details, is going to allow you to support that property based on your circumstances. And that is the crux of it, and it always will be the crux of it.
It's a really good point, and something you said there really triggered something with me, and this is those people that always look for a reason why not to do something, which to me is like alien. I never look for a reason why not, just always look for a reason typically to do something, right? I'm more driven that way. And I'll go, this is a reason why we should be doing it, and then I'll assess the risk around it, the reasons why not to do it. And I won't do it with too much bias. I'll say, this is a good idea, and I'll stress test that idea, and I'll stress test that hard, thinking about what's the worst that could happen, what is the worst case solution, and then you come up with an informed assessment. I know a lot of people, as you do, who go through life with all the reasons why they shouldn't do something, and therefore they never, ever do it. And if that's you, you can actually change your thinking.
Agreed.
Through education.
Absolutely.
You can do it. Like that, just because you are a particular way. And I've seen people do this themselves. They just go on a journey, and it's a bit of self-awareness. Maybe you can put this in your next chapter of a book or something or other. It's already got it, right?
Chapter 3.
Chapter 3?
Yeah.
Oh, that's what
mindset. It's all about mindset.
Yeah, we did a thing on it. You can actually change that and shape that. And you just need some tools in order to, number one, be conscious about it. And then number two, the steps in order to do it. It's not that hard. You said one of the reasons why, and this is a part of education, it's connected. One of the reasons why people haven't invested semi-recently was we went through all that APRA rigmarole, and rigmarole just being the bureaucracy of it all.
Royal Commission and banking sector.
A lot harder to get money. But then that was all sort of semi-sorted out, but then the federal election. Now, I had a chat during the week with Christopher Pyne, who is the ex-defence minister and previous to that.
He's retired now, isn't he?
Defence industry minister, but he was also, one of the movers and shakers within the Liberal Party, sort of, leader of the House, right? He's got a new book called The Insider, which I've read, and it talks really in a really simple way, and this is not, well, I guess it is a plug for his book because it's pretty good. It talks about that period of time in government when you had all this leadership change between Tony, to Malcolm, to Scott, all the rigmaroles around it, but just how politics works and how the mechanics of what you see as a punter in the media, what really happens behind the scenes for that to come out and
really
for how that is shaped.
You've got me wanting to read the book.
Yeah, go and read it because and it's easy to read. It's not like, pontificating stuff. It's like, it's just really anecdotal stories. And I read it and I just went, I'm not in politics, but I'm comfortable with politics and I get the ecosystem. I know a lot of people that operate within it. You have a particular view of politicians, which is the very sanitized and shaped thing you see on screen or in a paper or whatever. they're just normal punters like me.
Absolutely.
They're just guys and girls just, with a passion for community service or whatever their bent is.
Yep.
Some of them are driven by ego,
But just like every industry, it's the same thing.
But, you would think they hate each other on both sides of the house. They're actually quite collegiate.
Yeah.
But it's just the mechanics of politics and debate and discussion. And this is about the thought. Like, they debate issues before they can get to a point of going, this is what we're going to do. But the whole idea around Labor winning the election and then Liberal, Scotty ScoMo winning it, just that assumptive change. But that probably stopped a lot of Australians from investing in property when they probably should have been investing in property.
100%.
Because
it was the best moment in the market.
The best moment in the market before the election, counter-cyclical.
Yep.
Coming off a base of very little activity, investors being shaped through APRA. Like, APRA didn't want investors in the market. They were trying to float the fag first-time buyers and owner-occupiers. So if you were investing then, you would have seen that growth. Now we're at COVID right now.
Yep.
Which has sort of taken the wind out of the sail. But you got to know what's going on in Canberra.
The same scenario applies.
Yeah.
And this is it. The same scenario applies. And it comes back down to, we need to understand that Australia will and always will need, under the current regime, we need property to work. And if people think that there is another reason why we've had all the banks come down to the pathway of saying we've got 6-month mortgage holidays, which they've reinstated, that we've got JobKeeper, job seeker allowances, where we're looking at really targeted ways to prop up certain industries, do not for a moment think that this has got nothing to do with the property market. Property market is lynched, and the success of the property market is attached to almost every single industry and every single economical outcome that we have in this country, and it always will be. So if you think that the property market's got the ability to spiral out of control 40%, think again, because we're going through a motion right now where the talk about deficit doesn't exist right now. We're talking about how do we spend money? How do we borrow more money to spend it? Borrow, spend, and everyone's on that same bandwagon, and we will continue to do that. And this shows that in a point of pandemic where we need it, it's going to happen. If we've got anything else that comes to this market and affects it, we're going to do everything we have to do to prop up the economy, which also props up the property market.
But this is the challenge, right? Everyone's talking about, this ain't going to be our issue. It's got to be our kids' issue, right? Because they're going to be stuck with this huge sovereign debt that they'll have to work out somehow. I don't know, print some more money.
But we had the same issue when it came out of World War I, World War II. I mean, we had the same issues when we came out of these different things, and they unfortunately are going to be long-winded and essentially long drawn-out, multi-generational issues. However, the reality of cheap money means
they've always been there, though.
They've always been there.
We've got to run. And there was a question here, Paul, which we're not going to get to today, was around how COVID is any different from other economic crises. That's from Robert and Cottesloe out in Perth. Cool place. I had to swim there.
Awesome.
That's great. We're not going to be there for a little while, but I'm going to leave that, and we'll do that next time we get together. But just before we depart this conversation, you spoke about, and this is about which markets are best poised for growth post-COVID. You mentioned the supply side of things. Now, let's just dig into that a little bit. So property markets go up or down largely by market liquidity. Mm-hmm. What's available for sale will determine what happens in property markets. If everyone wants to move somewhere and there's nothing for sale, prices go up.
Yep.
If there's heaps of products available for sale but no one wants to live there, prices go down. Now, construction is a key driver of property market dynamics in Australia.
Yeah.
And what you're saying is that, yes, there is lack of students here renting properties. Yes, there is a huge reduction in migration, which has been a key driver of population growth in Australia. At a point in time, this is going to be impacted by construction levels. Now, construction levels pre-COVID, and I don't know the specifics of the numbers, you probably know more than me, was that we weren't building enough houses to sustain the population that was growing in Australia. So that's been turned on its head. So what's going to happen? So
we've seen HIA typically have the best data when it comes down to construction data, and that comes down to approvals and what's about to happen. So on the numbers there, as of about a month ago, it looked like there was close to about a 15% reduction in supply versus last year, or long term. And essentially, if you look at it long term, our run rate or our average is actually below what we need anyway. We're going to see in the next 6, 12, 18, 24 months, the supply level is going to be low. There obviously has been the first home buyer schemes that have been rolled out with the essentially $50,000 grants for new builds, etc. And that data won't reflect in the market for probably another 4 to 6 months. But anecdotally, it still is a very, very small portion of the overall property market. And the reality is that it still represents anywhere between 10 and 20%, depending on which market you look in. So it's not going to affect en masse what's needed. What we do need to see is the overseas migration, the skilled workers and the students in combination with natural births and deaths increasing to bring us into that, in line with that, somewhere between that 2 and 3% average annual population growth, or we'll probably touch under 2%, but that also leads to around about the requirement or the need for a couple of 100,000 properties to a degree, which was prior to COVID, that we need to actually fit that supply v demand, which we're not going to be anywhere near that. So the reality is, once the tap gets turned back on and we bring skilled workers over as well as international students over, we're going to be in that deficit again. And it goes back to your point, Phil, of going back to the federal election, as well as when we look at the post-Royal Commission into the banking sector, that was the best time to buy property in Australia, probably specifically in Sydney and Melbourne in the last 5 years. If you look at that, and again, these things leave clues. If you're thinking about what's going to happen in the next 2 to 3 years, and if you reflect back, when should I have bought? Hint, hint.
There we go. Paul, thanks for joining us today. It's quite a long episode, but it's good, these Q&As. We want more of them. Send your questions in or send us an audio one. You can even send us a direct message via any of the social channels, Smart Property HQ. If you're not yet following us or liking us, you can do it there and the team pick it up. Yeah, we should be doing this more often, at least once a month. Maybe not with you. We normally need talented people in the studio.
It's not very nice.
I know. I can't help myself, mate. No, it's good. It's really insightful, and it just gives us really good ideas about what to discuss, because it's like having our finger on the pulse of property investors, their fears, their concerns, what's exciting them right now. So it's a real good filter or view into the psyche of property investors based on the questions we're getting. And just by these collections, and to be fair, I've curated in this way, they're very COVID related, because that is what everyone's talking about right now. But COVID is dictating how people are approaching property investment right now, rightfully.
Yep.
But don't get COVID obsessed, because to your points, COVID ain't going to be here. Might be here forever, who knows? But there will be some equilibrium to the market, which will just be the way property works in Australia.
Correct.
And it's not going to be as a result of COVID. It's going to be just is because COVID is there. So embrace change. Embrace philosophy. Was it chapter 3 of your book?
Your mindset, mastering the mindset.
Master your mindset. And there's a couple of things that you have control of in life, and it's how you choose to think about stuff. So take control of that and shape your direction as a property investor. Thanks for your time, Paul.
Thanks for having me again.
Remember to check out smartpropertyinvestment.com.au if you're not yet subscribing to our daily morning newsletter, so you're the first to know what's going on property right across this great nation. smartpropertyinvestment.com.au/subscribe. Please, one favour, that's all I ask. And Paul, I want every single one of your clients that listen to the Smart Property Investment Show to do this. 1.5 stars. Please, can you keep those reviews coming on iTunes? I really do appreciate it. But as I mentioned beforehand, it's just not me behind the microphone. We have great connectivity with our guests like Paul Glossop, but the team here who make us sound good and do all the heavy lifting with that. They get a real kick out of it, the fact that they are helping and change and shape you and your views towards property investment. So please do that. It'd be a huge favour for me. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Whether you're an avid property investor or about to buy your first property, why do it alone when you could partner with Australia's best buyer's agent? Director of Pure Property Investment, Property Investment Professionals of Australia board member and REB Buyer's Agent of the Year, Paul Glossop, can take your portfolio to the next level. Get in touch today to discuss your investment goals. Get one-on-one insight from Paul Glossop. And for the first 100 people, this service is completely free. Head to purepropertyinvestment.com today to schedule your consult with Paul Glossop directly.